Welcome back. You're watching HFO-TV.
Let's give a warm welcome to Tim Dewey.
Thank you. All right, well, thank you. So I was asked to talk a little bit about the southern Willamette Valley, and then I, of course, started with interest rates because that's what I really like to do on top of the southern Willamette Valley sort of thing, and I think it was appropriate for this conversation and this time of the business cycle. So as you know, as was stated earlier, this is already the second longest expansion on record. Most likely will become the longest economic expansion on record. I think your probability of recession in the next 12 months is still fairly close to zero. So that's great news. But along the way with that, we're seeing interest rates rise as the Federal Reserve pushes up short-term interest rates in order to prevent the economy from overheating and try to extend the length of this recovery. And one way to view that, though, is certain interest rates have been actually range-bound for quite a long time. So, for example, interest rates on 30-year mortgages have been fairly range-bound for 3 or 4 or 5 years at this point. We saw a strong run-up in 2013 when then Federal Reserve Chairman Ben Bernanke warned about the end of quantitative easing. But since then, really, we've seen 30-year interest rates drift fairly sideways. And this is, I think, telling us something of a story. We know these interest rates are also tied to 10-year Treasury bonds very, very strongly over time. And the different colors here are different times. You can see the black dots at the top. Those are the 1970s, 1980s, where we have very high interest rates and also a little bit less of a relationship between mortgage rates and treasuries. But that really tightens up as you get further along in time. What we've seen is longer-term interest rates drop, and as those longer-term interest rates drop, that drops mortgage rates as well. One of the things that I think has been really important over this cycle is that we've really seen interest rates pivoting, the yield curve pivoting around the 30-year interest rate. So this is the interest rate of U.S. Treasuries as different horizons, and you can see that last interest rate, 30-year interest rates, is really locked down close to 3%. The green line here is when the Federal Reserve started tightening interest rates. The blue line is the path of interest or the pattern of interest rates last week. So what you see is that really we're seeing much more upward swing in the shorter end of the yield curve than compared to that longer end of the yield curve. Right? That's telling me about some limits that we can expect for interest rates to rise over the rest of this cycle. For whatever reason, actually I've got some idea of what the reasons are, longer-term interest rates are fairly well locked down right now, primarily for a couple of reasons. One is that we think that potential growth rates are lower, potential growth rates being a combination of productivity growth and labor supply. And as those things have gone lower, what we've seen is the neutral rate of interest. We think the rate of interest consistent with stable growth falling as well. So that's one factor. The other factor is a lot of demand for these longer dated assets, particularly as the population ages, particularly from overseas supply or overseas demand. Having these 30-year assets in which to transfer assets over generations has been very important. So the upshot, though, is that what we've seen is what we call a flattening yield curve. That the distance between short and longer term interest rates have really narrowed. That's what you see in a mature business cycle. As you get to a more mature business cycle, the yield curve becomes flatter and flatter and flatter, and that's what we've seen. Now, if this continues to hold and longer term interest rates aren't going to rise much beyond 3%, which seems to be a place where market buyers come into the market pretty aggressively, then the Federal Reserve might be closer than even they imagine to ending interest rate hikes. The Federal Reserve envisions by the end of 2020 that interest rates on the short end of the yield curve, short-term overnight policy rates, are going to be about 3.5%. Right? The current state of play, that would push interest rates above, short-term interest rates above longer-term interest rates, and would really put you in a situation where you've got to think about a recession in 2021. My expectation right now is, in fact, we flatten out the yield curve within a year, and the Federal Reserve will really probably have to make a choice whether they really want to continue raising interest rates at that point. So we could be closer than I would have expected 2 or 3 months ago to the end of this hiking cycle, which means that I'm not sure that you're going to get interest rates on longer term assets much above the 3% that we've gotten right now. And if it does, I suspect that would be largely temporary. So that's my interest rate outlook in brief. So what's going on in the southern Willamette Valley? Most of our economic indicators are very solid, particularly just as we might expect given the length of this recovery, what we're seeing in other parts of the state like Portland and Bend. We're seeing really those benefits filter through to the southern Willamette Valley as well. Unemployment rates, essentially for all intents and purposes, near record lows. Rising labor force growth, we've been able to draw more population, more workers into these local economies. Housing sales, I was reading through the latest RMLS report for Eugene and just continue to be shocked by the strength of the housing market. We're down to very low inventory rates. I've got that chart a little bit more. Really seeing a pace of housing sales in this area that is now exceeding what we saw during the housing bubble. Which is really remarkable when you think that that was supposedly a one-time issue. It really wasn't. We're not really seeing the pace of housing supply come online fast enough to meet that demand. There's not a lot of large-scale projects going on. There's been a number of apartment construction, particularly beginning in 2013, as people started to recognize the potential for new apartments for university students. Single-family housing has been very much constrained in the Eugene-Springfield area, certainly pushing up demand overall on housing and pushing up demand on both prices and rent. We'll talk about that in a little bit. Salem, very much similar. The labor force growth in Salem has been very high. Part of what we're seeing in Salem is a little bit of overflow from the Portland region, where Portland prices are very high. Labor shortages, maybe some firms to Salem. Seeing a high pace of housing sales and also seeing a very, I would say, restricted pace of building activity relative to the demand in the community. So when I look about these regional economies, I see some of the broader trends emerging. As this economy has continued in this expansion, it's maturing. We're seeing some job growth slow down. I don't get worried about that. I think it's largely supply side constraints more than anything else. Certainly, there's no evidence to me that firms are really workers at a rapid pace. So as a consequence, I look around the southern Willamette Valley and I'm very optimistic about the opportunities that lie ahead for this region. And I do think that it gets a boost having Portland be increasingly crowded. Certainly that's going to push population, I think, down the I-5 corridor as people get priced out of this market. What we're seeing as far as vacancy rates, I thought was fairly interesting. I was looking at the fall 2013 numbers and comparing them to fall 2017 numbers, trying to get the timing right. What we saw is Eugene vacancy rates fairly stable as the Eugene housing market, as builders have really been able to come into the housing market on the multifamily basis and put in new projects. And this was particularly, I think, relevant because they were able to start in 2013. A lot of big projects were getting underway in response really to a demand or perceived demand for the university area housing. And so that's, I think, helped sustain vacancy rates at fairly stable levels over that period of time. Salem was different, certainly in the data, where vacancy rates actually dropped quite a bit. Again, with the stronger growth and just the lack of housing development that we've seen in that region. What also struck me was, as expected, we're seeing higher rental prices. Very much so in Salem, I would say, compared to Eugene. That there's upward pressure on those prices is, again, we're just not bringing the supply to market that would be necessary to really constrain the growth of those prices. And so this is, again, over a 4-year period. What I thought was also interesting was the breakdown. So, for example, the 2-bed, 2-bath unit in Salem was not seeing a lot of upward pressure on rental prices. Whereas in Eugene, that was a big seller, the 2-bed, 2-bath market. And that's, I suspect, related to the demand from college students, right? You have a roommate, maybe you don't want to share a bedroom, or excuse me, you don't want to share a bathroom. And as a consequence, that type of housing really starts to become much more of a dominant place in the demand structure. Missing in Salem, though, is, say, the 2-bed, 1-bath market, where you're seeing much higher increases in rental prices in that particular category. So although both markets are seeing strong gains in housing prices, rental prices, it's not evident to me that, or it's clearly clear that both these markets have different underlying structures, different demand for the product, and largely driven by the fact that the Eugene area obviously has these 25,000 students running around, changing the dynamics in that market. Luckily, the benefit of having those students there is we were able to get some out-of-state builders to take advantage of that market and build more properties than might have otherwise been the case, whereas compared to Salem, where we just really, I haven't seen the extent of the housing supply come on market, and certainly I think that's showing up in the rental markets and the vacancy rates in that region. So that strikes me as a region where there's still certainly some opportunity for this kind of housing, definitely directed more toward families than college students. I wanted to show this. This is from the Salem RMLS because I was just shocked at how tight the housing market is. This is the inventory for houses in Eugene, and in March the number is 1.4 months of supply, and that's down from a ridiculously low 2.2, or what I thought was a ridiculously low 2.2 just a couple of years ago, and 1.4 actually puts this market at tighter than the Portland market, which has actually seen a little bit of relief as far as the housing demand market or the housing market has seen just a little bit of relief in recent years. That's, I think, a fairly shocking number, and really tells you what's going on here. Is that there's just super strong demand as there's population growth and economic growth that's fueling higher paychecks, more dual income households, and those things are really propping up these housing markets pretty aggressively, and we're just not able to bring the supply to these markets that would be necessary to satisfy this. This, I think, also puts upward pressure on the rental markets to the extent that the longer you're out of single-family housing, the more you have to find an alternative, the more you're in rental markets, so it's pushing up prices, I think, across the spectrum, that inability to find supply. I'm not particularly optimistic that we're going to find a lot of supply, certainly in the near term in these southern Willamette Valley markets. There's not, I think we've already discussed the constraints put upon us by the urban growth boundaries, and certainly that's biting fairly heavily, certainly in the single-family market. And like I said, there's certainly spillover effects, I think, into the multifamily market, the demand for multifamily as a result of that. Unsurprisingly, these are one of those, I like housing markets because they're kind of one of those places where when you get through all the regulatory and the policy issues, you kind of get back to some fairly simple economics 101. It's one of these places where Econ 101 works fairly well. Supply and demand, right? And I don't like to overemphasize basic Econ 101 because most markets are fairly complicated. These markets, though, if you build insufficient supply of housing, or you have insufficient land relative to the demand for the product, prices are going to rise, and they're going to rise fairly quickly. Certainly the gains in prices in, say, Eugene and Salem, those are the black and green lines, have not been what we've seen in Portland and Bend, but the income levels and the income profiles are different in these communities as well. So, generally what we're seeing, I think, is a situation where people are increasingly priced out of these housing markets as a result of the higher prices, or they're priced into surrounding areas more aggressively. And I don't see the likelihood of that trend continuing. My concern is that this is going to put constraints on the regional economies eventually. It's nice still to have a low-priced alternative to Portland and Bend. However, eventually as housing prices rise, that's going to put increased pressure on demand on firms to raise wages in order to maintain their workforce. I think one of the extreme examples I've heard of this is actually in the far south in Medford, where I was talking to one business owner who had purchased 2 condominiums. And the reason they purchased those 2 condominiums was to provide housing for new staff. This was part of his a recruitment program, was saying, look, I know this housing market's super tight. I'll let you live here rent-free for 6 months or a year until you can find new housing. That, of course, is expensive for a lot of firms to try to develop, but I think it gets to the greater point, is that these housing markets will eventually constrict and change our patterns of growth unless we are able to bring more supply, whether that be multifamily or single family. And so I am out of my 15 minutes here, but thank you.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.